absorption, we have to prepare the balance sheet after absorption under merger method as well as purchase method. Okay, merger method and purchase method. Let's see, a leading company A, another company B. If A company takes over B company and B gets closed, then this process is called absorption. But as per AS number 14, this process is called amalgamation only, where A and B both merged and formed a new company AB. A also joined with the AB, B also joined with the AB. Thereafter, company A and B closed. So, traditionally we can call this being acquisition or absorption. This will be amalgamation. But as per AS number 14, we have only one classification, merger, simply amalgamation. That amalgamation can be either merger method or purchase method. Can be merger or purchase method. Here also you can follow merger method. Here also you can follow purchase method. In case of merger method, okay, remember A company's balance sheet remains as it is, remains unaffected. A company takes over B company's assets and liabilities. While taking over the assets and liabilities of B company, all the assets and liabilities will be shown at its own book value, original book value. Even then, reserves and surplus of B company will be applicable or retained in the company of A, because it's a merger method. Merger means A and B join together to operate in the future, okay, with the consultancy of both the team. That's what about the merger. So B also having the rights to the extent of their own equity share capital, and B's company is also be continued. Their business also be continued even after the amalgamation. Is that okay? That's what about merger. Same company exists. So always remember, A companies, all the assets and liabilities are shown at balance sheet value, book value. Okay, assets and liabilities. But in case of B, that should also be shown at the book value, means assets, liabilities, as well as the reserves and surplus should also be maintained. Okay, if you are paying more or less than the equity, okay, equity shareholders, for them, their worth may be 1 lakh, but the payment made by A to them may be more than 1 lakh, 1,05,000, or sometimes less than 1 lakh. If the payment is more or less, this will be either profit or loss. That profit or loss by merging will be adjusted only in this account. Under purchase method, how this will appear? Under purchase method, how this will appear? A company is a continuing company, so they have to show all the assets and liabilities at their own book value. Right. Now B company's assets and liabilities taken over. Hereafter B company is going to be closed, and the B company shareholders are having no rights in that new company. They will not have any rights. Whatever you are worth, I have settled. Hereafter, don't ask me. Your business is mine. Whether I continue the business or shut down the business, it's none of your business. It's my business. Whatever the assets and liabilities of yours are taken over, it's an outright price. Whatever the today's value will be considered as my value. So I had to show at what value? Realizable value. And assets and liabilities are shown at realizable value, and reserves and surplus are totally removed. Is that okay? But in case of profit or loss and absorption, what happens here? The profit will be named as capital reserve, loss will be named as goodwill. Clear? This is what about the absorption type merger. Either it may be merger type or purchase type, whatever it may be, the format will be the same. And in case amalgamation, what happens here? Two companies are closed and a new company is formed to take over these two companies. Thereafter, company A and company B will not exist. Only we have the company AB. Both the companies are closed, So as both the companies are closed, in case of merger, we are going to record at its own what value? Book value. So you have to record at book value for A's asset, at book value for B's asset. Assets, liabilities, and resource and surplus should be maintained. And under this model also, assets, liabilities, and resource and surplus will be maintained. If there is any profit and loss, that profit and loss will be adjusted only in the resource and surplus. Here also in the resource and surplus. Okay. Ultimately, it's line by line addition. You just add up this, and this will be the new company's balance sheets information. The assets of A, assets of B, their book values clubbed and shown. Liabilities of A and B are just added and shown. And reserves and surplus, as it is going to be added and shown, but if there is any profit or loss, that will be adjusted in the reserves and surplus. After the adjustment, what of the leftover balance will be the balance of the new company. In case if you go for the purchase method, company A and company B both are closed. As both are closed, you have to consider the assets and liabilities at the realizable value. So, realizable value. This one also realizable value, this one also at realizable value. Right. Assets and liabilities are shown at realizable value. What about the reserves and surplus are? Never mind. Whatever the asset you have, I just take as it is. Whatever the commitment you have given to the third party, it's my responsibility to settle them. Assets are taken at realizable value, today's value. The liability is supposed to pay because of taking up your own business, also be at the realizable value. The difference between these two is the net worth. If I am paying more than that, then it's a loss named as goodwill. If I am paying lesser, then it's a gain named as capital reserve. So profit will be named as capital reserve, loss will be named as goodwill. What about here, sir? The same will be done here also. Okay, resource and surplus will not be considered. And profit will be shown at the CR and loss will be shown at the goodwill. Because of A, you have CR 100. Because of B, you have goodwill 150. What can we do, sir? By merging this CR and this is cancelled, only 50 rupees goodwill will be emerging. So the final combination, no, where you no need to have CR and the goodwill separately. Don't argue, sir. This CR is for A, sir. This goodwill is for B, sir. Because A and B will not exist hereafter. Both merged in only one new company. AB is formed. Hereafter, we don't have two independent companies. As we don't have these two independent companies, the profit and loss because of acquisition of these two companies will be settled in single name. Either it may be capital or goodwill collectively. Okay. A company's profit, B company's profit should be clubbed, or if by purchasing A company you may gain and by purchasing B you may lose, but you club that. You can club that. That's the logic here. Hope now you'll be able to understand. Now, let's start with this question number 2. Question number 2. Here, preparation of balance sheet after absorption under merger and purchase method. Balance sheet of SSA Limited and SBB Limited are there. Okay, SSA Limited absorbs SBB Limited. So this will be taken by SSA. Thereafter, SBB will not be exist. That is simply closed. Now, what happens in case of merger method? In case of merger method, okay, SSA leave, it should be continuing to appear at its own book value. For SBB, we have to show at the book value. We have to show at book value. Okay. This company, SSA, remains there. Only SBB is going to be closed. And as it's a merger method, all the assets and liabilities should continue to appear its own value. And the sum assured being, the consideration being 2,500, scenario A, we assume that the consideration being 2,500 rupees. In this case, equity share capital being 3,000, for them we offer only 2,500. As we pay lesser than their equity share capital, there is a gain. That gain will be added to this one. So this becomes 1,000. Leaving that, all the assets and liabilities will be recorded at its own which value? Book value. Under merger method, A's account will be shown at book value. B's account will be shown at book value. And on merger, you cross verify if there is any profit or loss, that will be adjusted in the resource and surplus. That I have done. How can I find out the profit and loss and absorption? What is the amount payable to the equity shareholders? What is the amount as for the books it's appearing? The amount appearing for the equity shareholders due being 3,000, but the payment is only 2,500. It's pretty sure you are paying lesser. As you are paying lesser by 500 rupees, is your gain. It's your gain. That gain may be simply added to the resource and surplus. Thereafter, current liabilities being 1,500. Rest of the things being the same. Now, SSA after absorption. SSA after merger. after merger. You have to add up these two. You have to add up 5,000 plus 2,700, 7,500, 2,000 plus 1,000, 3,000, 3,000 plus 1,500, 4,500, and 7,000 plus 3,000, 10,000, 3,000 plus 2,000, 5,000. This is what about the new balance sheet after the merger. 15,000 is the final value. If I follow purchase method, what happens? SSA takes over SBB. SSA takes over SBB. So, SSA should appear at its own which value? Book value. But SBB will not appear anyway. We have to take at a realizable value. Which value? A realizable value. Hereafter, SBB will not exist. As SBB is completely closed, whatever the assets and liabilities taken over by the purchasing company is the outright price. What is the worth for that? Today's price. Though the book value may be 3,000, if the realizable value today may be 3,500 or 2,500, whatever the value may be, you value that and take. If the realizable value data is not given, what we can do? You just take the value given in the books as the realizable value. In this illustration, as nothing stated, book value is equal to realizable value. Is that clear? In this case, what happens? We never take over the reserves and surplus. Because of any profit or loss, that will be named as either CR or goodwill. CR or goodwill. Hope so you could understand. Now see here. The amount payable to them is 2,500 rather than 3,000. You should not take this one. You should not take this one. It means in this case, equity shareholders worth being how much? 3,500. For the 3,500, you offer how much? 2,500 only. Okay, you offer only 2,500. 3,500 is the equity shares worth, but we are offering 2,500 rupees only. Reserves and surplus should not be shown hereafter. And current liabilities will be shown at its own market value or realized value. Non-current assets and current assets will also be shown at its own market value, 3,000 and 2,000 rupees. Now cross verify whether there is a gain or not. So net assets being 3,000 plus 2,000, 5,000. And 1,500 is the liability. If I subtract, then the ultimate value being 3,500. 3,500 is the net worth, but for them I am paying only 2,500. So I am paying 1,000 rupees lesser. The 1,000 rupees lesser is my gain. Under purchase model, whatever the gain may be, it will be named as CR account. Is that clear? You can see this way how net asset. Okay, net assets being the asset minus liabilities. Asset minus liabilities. So the asset in this case is 5,000, liabilities being 1,500. So net asset being 3,500. What is the purchase consideration? You are making payment of only 2,500. As you are paying lesser, so you gain. The gain 1,000 rupees is named as capital reserve. Or the other way, you just find out the equity. What is equity? Whatever the amount meant for the equity shareholders, you know, sum that will be called equity. Usually net worth is the equity. This is equity. Okay. What I calculate, what method I have calculated for the equity in this case is asset side approach. Assets minus liability, finding the net worth, which is equal to the equity, is called asset side approach. In case of liability side approach, go and see the liability side. What are the amount is meant for the equity shareholders? Just track. Equity share capital, any accumulated profits and losses, they know that is also for the shareholders. So this is 3,000, this is 500,000, 3,500 is the equity. That equity is otherwise net worth. If I add up these two and finding the equity shareholders fund or net worth, then it is the liability side approach. Or if I add up this one and subtract this one, by this way, if I calculate the net worth or equity, this is called asset side approach. You can follow one of the two approaches. So here, what I told is the equity shareholders value being 3,000 plus 500, 3,500 from liability side approach, but the payment is only 2,500. As the payment is less than the equity shareholders funds by 1,000, it's a gain for us. That gain is named as CR account. Okay, I introduce a new term here, CR. That CR being 1,000. Now simply add the SSA's assets and liabilities at the book value and SBB's restated value in the new one. So SSA's balance sheet after amalgamation being 5,000 plus 2,500, 7,500, 2,000 dash 2,000, capital reserve dash and 1000 and 3000 plus 1500 4500. In the liability side 7000 plus 3000 10,000, current assets 3000 plus 2000 5000. If we total this, the value being 15,000. Here also 15,000. Is that clear? This method is called absorption method. This method is called absorption. A company, the SSA company remains intact. It will work even after that. But SBB is merged with, whether it's a merger or purchase is the point you have to consider for the valuation of profit and loss to be adjusted. So if the profit and loss to be adjusted in the reserves and surplus, then it's a merger method. No, sir, the profit and loss will be named either CR or goodwill, then it's a purchase method. Is that clear? Hope now we'll be able to understand. Rather than it is being 2,500, if I make the payment being 4,000, how this will appear? How this will appear? Okay. Now, what happens? Under which method I'm going to follow? Merger method. Under merger method, as SBB is taken over by SSA, SBB will no longer exist. SSA's balance sheet will continue to appear at their own book value even after the merger. Even after the merger. For SBB, we have to now consider whether it's a merger or purchase, and based on that, you can take either book value or realizable value. I assume merger method is going to be adapted. As merger method is adapted, you have to consider only book value for the SBB. Okay. For SBB, we have to consider all the values at book value. Okay. Book value. So, as book value, always keep this one to be finished later on. Remaining, you can finish up first of all. Yeah, of course, they have to maintain all the assets and liabilities at the book value, including reserves and surplus also. But because of the additional payment or lesser payment, there will be profit or loss will be adjusted in the reserves and surplus. So, reserves and surplus gets slightly affected. But account will exist. Account will exist, but slightly getting affected. So, that account will be recorded later on. So, here this is 1,500, this is 3,000, this is 2,000. And 3,000 is the worth. But how much now we are offering? 4,000 rupees. B option. 4,000 rupees I am offering. So equity share capital being 4,000 rupees, as you are paying 1,000 rupees excess than their worth. That excess 1,000 rupees can be adjusted in which account? Resource and surplus account. If I adjust that in the resource and surplus, you end up with minus 500. Minus 500. We have 500 rupees in the credit side, liability side. Because of subtracting 1,000 from the 500, now we have only minus 500 here. Okay, yeah, of course, the value will be always tallying. You can cross verify whether the answer is correct or not. Yeah, correct. Now you have to find out the SSA's balance sheet after merger. After merger, you have to merge these two values: 5,000 plus 4,000, 9,000, 2,000 minus 500, 1,500, and 3,000 plus 1,500, 4,500, and 7,000 plus 3,000, 10,000. 3,000 plus 2,000, 5,000. The ultimate total be 15,000. Okay, here 15,000. You got the value tally. Sir, what happens if I adapt purchase method, sir? Under purchase method also, SSA remains at the same book value. Only SBB is going to be converted into realizable value. So SBB at what value? Realizable value. And here book value and realizable values are same. First to finish up posting all the assets and liabilities. Assets and liabilities. So 3,000, 2,000 and 1,500. As it's a purchase method, we don't value the reserves and surplus separately. We club those two. Okay. By clubbing the equity shareholders worth being 3,500. Totally 3,500. We don't have the reserves and surplus here. Under purchase method, transferor company's resource and surplus will be cancelled. Okay, for the equity shareholders value, if you are paying more, then it's a loss named as goodwill. So here 3,500 is the equity shareholders net worth, liability side approach. Equity share capital plus resource and surplus. If you add and find the equity shareholders funds, that will be called as what? Liability side approach. So as per the liability side approach, it may be 3,500, maybe 3,500, but we pay 4,000 rupees. As I pay 500 rupees excess, it's my loss. That loss under purchase method will be named as goodwill. Goodwill will be shown in the asset side. I introduced no new account here, goodwill. Now you can prepare combined one. SSA after merger. After merger or purchase. After amalgamation. 5,000 plus 4,000, 9,000. Resource and surplus 2,000. Current liabilities 3,000 plus 1,500, 4,500. And non-current assets 7,000. The goodwill is there 500 rupees. Non-current assets 7,000 plus 7,000 plus 3,000. Okay, 10,000. 3,000 plus 5,000. So 3,000 plus 2,000. 5,000. 1,500. Balance sheet total. Clear? Now let's move on to the merger concept. Means mingling these two. Existing two companies closed and formed a new company. Amalgamation type. Amalgamation type. Traditionally, this will be called as absorption, and the other way is called means amalgamation. But we call currently only amalgamation as per AS number 14. Okay. Now let's go to this. Go to this. Okay. So we have to follow purchase method and pooling of interest method. You have to prepare the balance sheet directly for this illustration. Right. What happens here? SSA Limited, SBB Limited amalgamated to form a new entity set. Set Limited is formed to take over SSA as well as SBB. After this, SSA will not exist, SBB also will not exist. These two are closed. And for that, the purchase consideration could be 9,000 to SSA, 12,000 for SBB. 12,000 for SBB. Okay. Set Limited issued equity share capital of rupees 10 each, allocated to SSA Limited and SBB Limited according to their respective net worth ratios. Net worth ratios. Okay. If the first one is 9,000. The purchase consideration payable being 9,000 in first scenario, scenario A. Now the question is, out of 9,000, how much is for SSA and how much is for SBB? For that calculation, we have to use net to worth ratio. Net worth ratio is nothing but assets minus liabilities. Now, assets minus liabilities. Asset minus liabilities for SSA and SBB net worth. This is asset. This will be liability. We have only one liability. Now you can find out easily the difference between total assets minus current liabilities. First case 7,000, next case 3,500. And the ratio being 2:1. The ratio being 2:1. Net to worth ratio. This 6,000 is now segregated in that same ratio 2:1. 6,000 is the purchase consideration for SSA. 3,000 is the purchase consideration for SBB. Is that clear? Clear? Hope you will be now able to understand this. 6,000 for SSA and 3,000 is for SBB. As SSA and SBB both are taken over by set. Okay. So now SSA and SBB should pay the consideration, get the consideration from set, and the total consideration for these two companies put together is 9,000. Out of the 9,000, what is the amount for SSA and what is the amount for SBB? If you ask that question, the last line is clearly stated that purchase consideration allocated to SSA and SBB to their respective net worth ratio. Net worth is nothing but assets minus liabilities in case of asset side approach. In case of liability side approach, you just find out the equity shareholders worth, which is nothing but equity plus resources surplus. 5 plus 2, 7, 3,000 plus 500, 3,500. That way also you can calculate. From this, it is very clear SSA's net worth is 2 times of the SBB. SSA's net worth is 7,000, SBB net worth is 3,500. So SSA is 2 times of the SBB. Otherwise, 2 is to 1 ratio. The entire 9,000 will be segregated to SSA and SBB in that same ratio, 2 is to 1, 6,000 and 3,000. Right. Now I'm going to solve this illustration. Under what model I'm going to solve? In case of merger, SSA also closed, SBB also closed. But in case of merger, you have to consider only at book value. SSA also, SBB also. At what value? Book value. Book value. In case of purchase, you have to consider only realizable value. Leaving the equity and resources surplus, all the assets and liabilities will be now taken at its own book value or book value. Here 3,000, 1,500, 7,000, 3,000, 3,000, 2,000. Is that clear? I have chosen all this value here. Clear. Now, equity shareholders' net worth in this case being 7,000, but we offer how much? 6,000. Otherwise, you just consider only equity share capital account. Okay, only this one. Equity share capital for SSA being 5,000, but the shares offered to equity shareholders of SSA being 6,000. You offer 1,000 excess. As merger method, any profit or loss will be adjusted only in the reserves and surplus. So, reserves and surplus, we have 2,000 rupees. In that, I subtract 1,000, so the remaining being 1,000. Cross verify whether the assets is tallying with the liabilities value. Yeah, of course. Asset side, we have 7 plus 3, 10, and liability side also we have 6 plus 1 plus 3, 10. In case of SBB, 3,000 is the value, but we offer how much? 3,000. Exactly. I don't offer more. So, there is no profit or loss, so the reserves and surplus will be intact. Now, set after merger. Set after merger. It's nothing but line by line addition after this. 9,000, 1,500, 4,500, 10,000 and 5,000. The overall value being 15,000. 15,000. So we have completed the merger method. Let's move on to the purchase method. Let's move on to the purchase method. Under purchase method, SSA will be taken at what value? Realizable value. SBB should also be taken at what value? Realizable value. Is that okay? Here we don't identify these two separately. Okay. You have to club this one because we don't show the reserves and surplus independently. SSA also closed, SBB also closed. Rest of the assets and liabilities I will finish up first of all. For current liabilities, it is 3,000 and 1,500. And here 7,000 plus 3,000. And here the value be 3,000 and 2,000. 3,000 and 2,000. Is that okay? 3,000 and 2,000. The amount offered for SSA being 6,000. Actually, their net worth being 7,000. Net worth 7,000, but we offer only 6,000. We offered lesser. As there is a gain, it will be named as CR. CR 1,000. We don't have reserves and surplus here. We don't have reserves and surplus. Okay. Then for SBB, we offer 3,000 rupees. We offer 3,000 rupees, but their worth is 3,500. So we get a resource and surplus cancel, but we have the CR. We have the CR. So when it's all about merger, compare the equity to equity. Equity share capital, equity share capital. Equity share capital and purchase consideration offered. In case of purchase method, net worth is 7,000. For that, we are offering only 6,000. We gain say 1,000 rupees. The net worth of SBB is 3,500, but we offer only 3,000, lesser offering. So gain is named as capital reserve. So the new balance sheet after the merger for set to be line by line addition of these value hereafter. CR 1,500, we don't have reserves and surplus, and current liabilities being 4,500. And in case of assets, of course, it remains unaffected. So 10,000 and 5,000, 15,000 rupees. Hope the assets and liabilities are now merging. Assets and liabilities are merging. Is that clear? Shall I move on to the next one? If the purchase consideration fixed rather than 9, if it is 12,000, how this will appear? Okay, how this will appear. Now, so we have completed this one. Now I will be moving on to this one, 12,000 case. And this is the purchase consideration set takes over SSA as well as SBB. Hereafter, we don't have SBB or SSA, both are closed. B scenario where the total consideration being 12,000. The total consideration is allocated to SSA and SBB according to their respective net to worth ratio. Net worth. Liability side approach. Equity share capital as well as reserves and surplus. This is liability side approach. 7,000, 5 plus 2, 7,000, 3,000 plus 500, 3,500. 7,000 and 3,500. The net worth ratio is nothing but shortening this 2:1. This purchase consideration should be subdivided to these two in their net worth ratio, which is 2:1. So 8,000 for SSA, 4,000 for SBB. Now we'll start with merger method. Under merger method, we have to show at book value and reserves and surplus should be maintained. Reserves and surplus should also be maintained. Applicable for SSA as well as SBB. In case of any profit or loss because of the merger will be adjusted only in the reserves and surplus. Finish of posting the assets and liabilities first at its own book value, though market value given should not be taken. Anyhow, market value is not given, not required for me. 7,000 and 3,000. 7,000 and 3,000. In case of current assets, 3,000 plus 2,000. 3,000 and 2,000. Clear? Now the worth of SSA being 5,000 plus 2,000. First we will consider only equity share capital. 5,000. For the 5,000 we are offering 8,000 rupees. We offer how much excess? 3,000 excess. Any excess payment is a loss will be adjusted only the reserves and surplus, but reserves and surplus is not capable. Then if I subtract the 3,000 rupees from the 2,000 rupees, now the reserves and surplus is negative 1,000. So negative 1,000. Similarly for SBB, 3,000 is the value. 3,000 is the value where 4,000 is the payment made. 1,000 rupees we are paying excess. That 1,000 excess payment is a loss will be adjusted the reserves and surplus. Already we have the reserves and surplus 500 only, but we have to subtract 1,000 from here. So we end up with the loss 500. Now prepare set. Now prepare set, the combined one. It's a line by line addition of this. 12,000, reserves and surplus 1,500, 4,500, and assets 10,000. This reserves and surplus being negative value, and current assets being 5,000. The total of assets being 15,000, and the total of set also being 15,000. Also being 15,000. Is that clear? SSA, SBB and set. Let's now move on to the next one. What happens, sir, in case of purchase method? Purchase method. Under purchase method, you have to consider at the realizable value and reserves and surplus will be scored out. In case of profit, named as CR. In case of loss, named as goodwill. If you are merging two companies, amalgamating two companies, one company shows CR, due to the another company's purchase, there is a goodwill. You can simply club these two and net it. You can net it for SSA as well as for SBB. Whatever it may be, first you have to consider only the assets and liabilities to be shown at a realizable value as it is being the purchase method. 7,000 and 3,000 and 3,000 and 2,000. 3,000 and 2,000. Okay. And here being 3,000 plus 1,500. Now, what is the worth of SSA? Net worth of SSA? 7,000. Amount offered for them is 8,000 rupees. Now you are pretty sure you are losing 1,000 rupees. The loss will be named as goodwill. Loss will be named as goodwill as it is being which method? Purchase method. Under goodwill method, so under purchase method, the loss is named as goodwill because he is different, I am different. Okay, if the same company is continuing and both are same persons. So the existing companies, the transferor company's loss becomes the transferee's company's loss can be adjusted there. But it is not so. It is not so here. And 3,000 plus 500, 3,500 is the worth of SBB. For them, we offered 4,000 rupees worth equity share. As we offer excess, it's a loss, and after the loss, after this purchase, SSA and SBB has no connection with the said company. That's the third party's company's loss. That third party's company gets more consideration from you. It's a loss that will be named as goodwill. Okay, we don't have the resource and surplus. Now prepare the set after the purchase. 8 plus 4, 12,000. No resource and surplus. 3 plus 1,500, 4,500. 16,500. And in case of assets, we have non-current assets, that too intangible. This may be tangible assets. This one being intangible assets. 1,000 plus 500, 1,500. 7,000 plus 3,000, 10,000. 3,000 plus 2,000, 5,000. Then overall value being 16,500. Hope you will be now able to understand this one. Clear? Any doubts? Question number 4. This fourth illustration, one of the comprehensive illustrations for understanding the basics. Understanding the basics. Now, what happens here? What is the requirement? Past journal entries for dissolution of SBB. SSA Limited absorbs SBB Limited as on the above balance sheet date for a lump sum consideration of 3,000. So SBB is taken over by SSA. Thereafter, SBB will be closed. Right. And for that, SSA makes a payment of 3,000 rupees. So SSA offers 3,000 rupees and gets all the assets and liabilities of SBB merged with. So now you have to prepare past journal entries for dissolution of SBB, prepare ledger accounts for dissolution of SBB, also require the following under purchase method and pooling of interest method to pass journal entries for absorption in the books of SSA Limited and prepare the balance sheet of SSA Limited after absorption. So you have to do all the calculations. All the calculations. Now, we know to prepare the balance sheet directly, but apart from that, we have been given some additional points to be carried over. So, a comprehensive illustration will have what? Will have purchase consideration calculation, dissolution, and incorporation. Incorporation journal entries and new balance sheet. We have 4 methods of purchase consideration. The easiest one is lump sum. Straight away, the worth is given under this method, lump sum method. In case of dissolution, you have to prepare realization account, purchasing company or purchase consideration, purchasing company, and then equity share capital. What we have done here is ledger. Not only ledger, you need to sometimes pass the journal entry also. In this illustration, I have asked you to pass journal entry and prepare the ledger to dissolve the company. In case of new company or transferee company, you have to pass incorporation journal entry. We have 3 incorporation journal entries. Number 1, business purchase, and 2, liquidator. Number 2, make the payment to the liquidators. Okay, the business purchase is converted into assets to liabilities, and the difference between these two is business purchase. And you may either get the profit and loss. In case of profit, it will be named as CR in the credit side, capital reserve. In case of loss, it will be named as goodwill, debit side. Third one is all about make the payment to the liquidator. So liquidator of transferor company to the mode of payment, maybe equity share capital or preferred share capital. Thereafter, you have to prepare the balance sheet. In the earlier 2 illustrations, we directly prepare the balance sheet. Sometimes you may not be asked to prepare the balance sheet directly. You have to go step on step. Okay, even you have to calculate the purchase consideration also. Second, transferor companies are going to be closed. Third, in the transferee company, these assets and liabilities incorporated by passing 3 journal entries. Then those will be added to the original balance sheet. And in case of pooling of interest method, these two are not same. Rest of the things are same. Only the second entry will be totally different. Assets account debit to liabilities, to reserves and surplus, and to business purchase. Any profit or loss will be adjusted in the reserves and surplus. Here you are going to show all this value at the book value. In this case, we show all the values at realizable value. This is the only difference. So we have been asked to pass the journal entry and prepare the balance sheet in the books of transferee company and the purchase method as well as pooling of interest method. This method as well as this method. Right. Now let's see lump sum consideration. Straight away go for closing the books. To close the books of accounts, you directly prepare the ledger. After preparing the ledger, you of course, if journal entries are asked, you can prepare post the journal entry also. Usually, pass the journal entry and post that in the ledger, but we do the reverse way. Right. Now let's see. Which company is going to be closed here? Only the transferor company is going to be closed. Transferee will continue. So I am going to prepare dissolution ledgers for transferee company, which is the SPV. Okay. Here. Okay. We'll start with the realization, dissolution case, liquidation or dissolution. First ledger account being realization account. Second account is all about purchase consideration account. Third one is all about purchasing company account. Who is the purchasing company here? SSA. I can use his name, SSA account. And equity share capital or equity shareholders. Okay. Now, equity share capital. Record the balance sheet items. By equity share capital 3000. Reserves and surplus is also for the equity shareholders, so transfer that to the equity shareholders 500. Current liabilities and assets are shown in the realization account. So by current liabilities 1500. And these two assets are going to be shown here. 2 non-current assets, current assets. Okay. How do I prepare the realization account? Realization, purchase consideration, purchasing company in equity shareholders. Post the ledger account items, balance sheet items. While posting, the assets will go directly the debit side of the realization account at the book value. Liabilities will be transferable to the credit side of the realization account at the book value. Reserves and surplus equity share capital will be transferable to the equity shareholders account. Clear? So we have done that. We have done this. Now, at what value these assets and liabilities, net of liabilities, is taken over by the company? Means transferee company. Under lump sum method, it is found out that it is 3,000. I just post that here. Purchase consideration. And in purchase consideration, 2, realization account. This amount should be payable by whom? SSA account, 3,000. Under SSA, 2, purchase consideration. We assume this 3,000 purchase consideration payable by SSA to the owners of SBB by way of equity share capital. As pooling of interest method is asked, you are aware about that. The purchase consideration should be paid off only by the equity shareholders, equity share capital form. Whether it's stated clearly or not how the purchase consideration settled, you can guess this way. Usually the purchase consideration paid by way of equity share capital. So by equity share capital of SSA, 3,000. What about this 5,000, sir? Is it 5,000? Oh, 3,000. What about this 3,000? This 3,000 is nothing but the equity share capital of their own company, SBB. Instead of that, if you are being the equity shareholders of SBB, after the dissolution of SBB, SBB will not exist. Then as the shareholder, you demand what happens to my shares, sir? Don't worry. You will get a fresh share from the new company, SSA. So as you are losing the shares of SBB, you will be now getting SSA's share. So, 2, equity share capital of SSA, 3,000. Right. Now, tally this. By tallying the realization, you find profit and loss on realization. Assets being 5,000, liabilities being 1,500. 3,500 is the worth. But we got only 3,000, so there's a loss. So there is a gain, okay. Loss. So there's a loss. As the owner, you are getting 500 rupees lesser loss. It will be transferred to the equity shareholders. Whatever the profit or loss in the business is shared by or taken by the owners only. So that loss is transferred to the equity shareholders. So here, realization account, loss. In bracket, loss. Realization loss, 500. Now purchase consideration gets closed. SSA also gets closed. Equity shareholders also gets closed. Step number 1, calculation of purchase consideration was already done. Step number 2, close the transferor company. In step number 2, sometimes you may be asked to pass the journal entry also. Now I am going to pass the journal entry. Before we move on to the next step, I will finish off the journal entry here. Right. What are the journal entries are going to be prepared? One is transferring asset to the real estate. First, close the balance sheet item now. For closing the balance sheet items, what are the things are there? Assets, liabilities, and owner's fund. Assets will be transferable to the realization account debit side. Okay, realization account debit side. Liabilities are transferable to the realization account credit side. Equity will be transferable to the equity shareholders account credit side. Is that okay? That's all. Thereafter, you have to incorporate purchase consideration and all. See, we start with this one. So, the entry for the transfer of assets, entry for transfer of the liabilities, second entry for transferring the owner's fund to their owner's account, 3. These are the 3 journal entries you have to pass to close the balance sheet items. With that, the balance sheet is now closed. From the adjustment, we found out only one item, purchase consideration, to be incorporated. That purchase consideration should be the credit side of the realization. And thereafter, this will be recoverable from SSA. So, it is going to be transferred to SSA account and it is recoverable from SSA by way of equity share capital. So, 3 form. See here, for the asset, realization account debit to non-current assets to current assets. Usually, all these values are recorded at book value because whatever the assets and liabilities we have should be closed. The closure will be done by transferring in a reverse account at its own book value. Assets are shown as a debit balance. To close that, it should be credited. So I am crediting realization to non-current assets. All the assets will be in the debit side. To make it zero, as the company doesn't exist, the asset will also doesn't exist. So the asset closure will be done this way by crediting. As we are crediting those assets, where it should be debited, a new account called realization, temporary account, nominal account, realization account is a nominal account. That will be closed. So here realization account, non-current assets being 3,000, current assets being 2,000, the overall value in this case being 5,000. Second step, current liabilities. Current liabilities account debit to realization, This value being 1,500, 1,500. Current liabilities will appear in the liability side. Liability side means credit balance. To close that, it should be debited. As current liabilities is debited, and it should be transferable to the realization account here. Then next one being equity shareholders fund. Equity share capital account debit. Accumulated resource and surplus we have meant for the equity shareholders also be transferable to the equity shareholders. This value being 3,500. 3,500. Thereafter, incorporation of purchase consideration. First, you have to pass the purchase consideration for the assets and liabilities. Second one is you have to pass the entry for the due. Third one is settlement. Three entries we have. Understand? See here. First one is purchase consideration entry. Second one is purchase consideration due entry. Third one is purchase consideration payment entry, settlement. Three entries will come. Okay. Purchase consideration for assets and liabilities. For the first one, the journal entry is this one. Purchase consideration account debit, PC account debit to realization. This value being 3,000. And next entry being, this is the first one, this is the second one, this is the third one. That's all. 3 entries. What about this one, sir? This one is equal to this one only, no? Purchase consideration to realization, purchase consideration to realization. So we need to pass the entry for this one, and this one. Naturally, this entry is automated. Okay, this entry is automated. So the first entry for the purchase consideration for various assets and liabilities being purchase consideration to realization. Next one is due. Sir, you have to pay the amount. Whom? SSA. SSA is my debtor. SSA is my debtor because he takes over my assets and liabilities. For that he has to pay. He is my debtor, so I am debiting him. For what reason, sir? To purchase consideration. Okay. So sales. For us, it's a sales. What is the duality for the sales in credit? Okay. Debtors to the same happens here. Debtors being in this case SSA to sales. But this is in the point of view of the buyer, no? For him, it's a purchase consideration. Very simple, right? So here the value being 3,000. Next, how the SSA settles this? By way of their own equity share capital. So the entry being equity share capital of SSA account debit to SSA. The value being 3,000. You can pass one more entry. The equity share capital of SSA is taken over by whom? Equity shareholders of SBB. You can pass this entry also. This one entry separately, this one entry separately. 3 and 4. Otherwise, you can have one more ledger here. Equity share capital of SSA. Okay, then the entry will come here and will come here. That's how you can introduce one more ledger also. For that one more ledger, I just show this way. See how this will happen. So here, equity share capital of SSA. Here, SSA account 3,000. So now we got this one. The settlement is done. Okay, this is the settlement entry. You can even pass one more entry. Okay, the purchase consideration settled, then purchase consideration given to owners, given to equity shareholders. Then automatically this entry will come. So this will be equity shareholders account. If you want to show, you can show this way. Okay, So equity share capital of SSA is the settlement made by the purchaser. That settlement, what we received by the liquidator, is going to be offered to the equity shareholders. For that, the entry being fourth entry. This will be the fourth entry. Equity shareholders account debit to equity share capital of SSA account debit credit, value being 3,000. And finally, you close the ledgers. While closing, first you close the realization account and you find out whether there is profit or loss. So if there is any profit or loss on realization, that should be identified, okay, and transferred to owner only. Here we get the loss. This is the loss entry. Equity shareholders account debit to realization account. Naturally, it may be a loss, 500 rupees. Understand that if you club all these journal entries, you get directly equity share capital of SSA. That's all these ledgers not required. But anyway, give more detail. For the detailing only, we have so many steps. In the very first step, what happens? We find out the amount payable for the various assets and liabilities. The next one, we consider this being the due entry recoverable from buyer. Third, the consideration is now recovered in the form of equity shares or whatever it may be. Fourth, that consideration is offered to the owner. These are the 4 steps. When I studied this at my PG level, MCOM, I got surprised because I studied in correspondence. I got the book. In the very first book, they gave these are the ledgers 1, 2, 3. Another ledger they gave 1, 2, 3. In another case, they have given 1 and this is second. That's all. I got so many confusions. What happens in between? So now you'll be able to understand that structure. Whatever the assets or liabilities, for that, what you offer is the purchase consideration for this one entry. Who has to pay? The payer is now made a debtor, so due entry. Has he paid? Yeah, sir. That will be the settlement mode. What I get due to the settlement with that, I'm going to offer to the equity. So 4. This is the complete set. Is that clear? Now let's move on to the next one. We are going to pass directly in the books of whom? Buyer. Let's see. In the books of buyer, we can very easily solve this illustration. So the payment being 3,000. Clear? Now what are the 3 entries are going to be passed? Entry number 1 is all about business purchase. So in the books of SSA, under purchase method, okay, business purchase account debit to liquidator of SBB. How much we are offering? 3,000 is the purchase consideration. For the business purchase, what we are getting? These are the assets and liabilities. Non-current assets, debit. Current assets, debit. To current liabilities, to business purchase. 3,000, 2,000, current liabilities being 1,500. The value payable to them is 3,000. By tallying, I will get profit and loss. Of course, I have profit, so that will be named as capital reserve. Is that okay? 5,000. But credit side has only 4,500. That's a shortage, 500 rupees. Then it's a gain for us. The next entry being settlement to the liquidator. In case of settlement, liquidator of SBB account debit to how we make the payment? Equity share capital of our company 3,000. That's all. Now we can prepare the balance sheet. Equity share capital Earlier 5,000 and now here is 3,000, 8,000. Business purchase debit, credit got eliminated, liquidator credit and debit got eliminated. Rest of the items are going to be shown. Reserves and surplus, reserves and surplus, okay, 2,000 rupees, and we get CR here, value being 500 rupees, and current liability is 3,000 and 1,500, 4,500. Non-current assets 7,000, 10,000, 7,000 plus 3,000, 10,000. Current assets 3,000 plus 2,000, 5,000. So in the very first illustration, we directly prepared the balance sheet, but in this case, beforehand, what happens? We have 3 steps. Due for purchase consideration. Next one is purchase consideration will be shown as an assets and liabilities, so I am renaming. Third one is settlement. After that, this entry will be incorporated with the SSA and you can prepare the new balance sheet. You will get automatically tallied. This is what about the balance sheet for SSA. 15,000. It got closed, I think. Isn't it? 15,000. Sir, what happens, sir, in case of merger method? As I already told you, in case of merger method, you have to follow pooling of interest method. Under pooling of interest method, only this entry is not same. Rest of the entries are same. First entry being business purchase account debit to liquidator of SSA, SBB, value being 3,000. Now you have to show all the assets and liabilities at its own book value only, including resource and surplus. Including resource and surplus, let's see. I've just considered all these things. First, you finish up recording all these things. Non-current assets, debit, 3,000 rupees. Current assets, debit, 2,000 rupees. To current liabilities, 1,500. To reserves and surplus, I have to adjust that for any profit or loss. Finally, to business purchase, 3,000 rupees. Actually, SBB value is 3,000. The payment is also 3,000. No profit, no loss. The reserves and surplus will be intact. Third entry being settlement. Liquidator of SBB to equity share capital. The value being 3,000. Business purchase got eliminated. Liquidator got eliminated. Now we have to prepare new balance sheet after this amalgamation. 5,000, 3,000, 8,000. Resource and surplus 2,000 and 500, 2,500. We don't have CR. Current liabilities 4,500. Non-current assets 10,000. Current assets 5,000. 15,000 got total. Hope you will be now able to understand both the methods. All the steps are covered with a simple illustration. In subsequent class we'll go for some advanced steps, right?